This is a video on what's called the two-finger exercise. I actually found this technique for evaluating financial statements in a manager's desk guide some years ago, and I thought it was really useful, and I certainly think it's a quick and easy way to get a handle on what's happened to a company during over a particular year. And actually what it does is it doesn't look at any of the statements that represent changes, for instance the income statement or statement of owner's equity, even the statement of cash flows. It just compares two balance sheets, and so the exercise itself is so called because you simply take the columns of two successive years of the company's balance sheets and note the changes, make some observations about that. I think as you'll see, it's a pretty sensible way and an easy way to get a handle on for understanding what happened to a company, where money came from and where it went for the period. So without further ado, let me give you a little background first. This is sometimes used by me in a managerial finance class to give a background on how to review financial statements. So it's part of a bigger picture, as we'll see when we study financial ratio analysis. It helps to give a picture of, again, evaluating a company's financial performance, what happened over the course of a year, and financial position, where they stand at a particular point in time. The focus here actually in this two-finger exercise is surprisingly on cash flow. It's not the statement of cash flows, it's actually looking just at balance sheets. But the focus, as we'll see, is on where cash came from during the period and where it was used, where it went to. First of all, let's notice this about cash flows. Revenues and cash receipts for a firm are not generally going to be the same for a given period. Sometimes companies, for instance, will allow customers to pay late or pay after the sale, so they record the revenue when the transaction occurs, and then the cash is received later on. So there's can be something of a mismatch between the timing of recording revenues and recording the cash flow related to revenue. Same thing goes for expenses. Sometimes companies will pay for expenses after the fact, that is, after they consumed and enjoyed the benefit related to that expense. Sometimes they'll pay in advance. There are certain types of expenses, prepaid rent or insurance, where customarily we pay in advance of the period that the insurance or the rent covers. So revenues and cash payments, revenues and cash receipts are not the same. Why not? Very generally because financial statements prepared according to GAAP generally apply the accrual basis of recording revenues and expenses. And this contrasts with what we know is the cash basis. And here's, I think, a good summary of the differences between those. Under the cash basis, revenues are recorded when the cash is received, not necessarily when the right to receive it, that is, the earning of that revenue takes place. Under the accrual basis, revenues are recorded when they are earned, that is, when the seller has conveyed the good or has completed the service that represents or gives them the right to claim that they have earned that income. Under the cash basis, expenses are recorded when the cash is paid, regardless of when the obligation occurs. And expenses under the accrual basis are recorded when they are incurred. That means not just that the benefit has been received, but in fact that the benefit has been consumed, that has been used up. Cash is king. Sometimes cash is described as either the lifeblood of a business, or it's described as the oxygen that a business needs in order to survive. But we say cash is king, cash is preeminent. One of the basic explanations of that, I guess the most basic explanation, is that cash is the best measure of economic benefit that we know. You can't go to the bank and deposit net income. You have to deposit cash. So you can imagine how humorous it might be or frustrating it might be for someone to try to go to the bank and deposit net income, to take their income statement and say, I want to deposit this net income. The teller at the bank will say, well, where's the cash? Oh, I haven't earned it yet. I haven't got it all yet, but I've earned it, you see. And of course that would never happen. You cannot buy a loaf of bread with $1 of net income. You have to have cash. You can't make deposits of net income. You have to have cash. But cash flow, although it's simple in broad concept, measuring it is not quite so easy sometimes. It can be quite challenging. And that's why there's the statement of cash flows, to help show where cash came from and where it went during a period, and of course to account for the net change in cash for a given period. But we're going to take a quicker approach to that, to estimating cash flows or measuring cash flows from and into a business. And we're going to call this the two-finger exercise. Now here's the broad overview, and then we're going to look at an example that we used in class. First of all, to apply it, we're going to take two balance sheets of a company, put them side by side for 2 successive years. And first of all, we're going to look at the upper part, at least in the report form of the balance sheet, to consider the company's assets. First of all, to determine how much the company's assets grew during the period, both in dollar terms and in percent terms. And then we're going to look, second step in this first part, to note whether the growth occurred mostly in current assets or in non-current assets. Whether most of the growth occurred in current or non-current speaks to the company's liquidity, at least liquidity of its assets. And then thirdly, we're going to identify the 2 or 3 most significant changes that occurred within the assets. For most companies, the major asset accounts are going to be accounts receivable, inventory, and property, plant, and equipment. Those are going to be the 3 biggies in terms of where your dollars show up. That doesn't mean that cash is not going to be large sometimes, but it would be generally fairly rare for cash, for instance, to be large, because cash is, for the most part, a low-earning or non-earning asset. And so a company really can't afford to have too much money tied up in cash for very long. Now, after we cover the assets, get the big picture. Again, this is you can think about this in terms of going from a very general perspective on the business to a more focused perspective. First of all, we're looking at assets. The big picture: did the company grow? If so, how much? In both dollar terms and in percent terms. Then let's focus on that primary delineation within the assets, current and non-current, also known as short-term and long-term, and see whether most of that growth occurred in current or non-current, or if it was evenly split between the two. And then make an even more, let's say, focused approach at the line items, the categories of assets: cash, receivables, inventory, again, fixed assets, investments, to see where most of that money went. But after we do that, we turn our attention to the lower part of the balance sheet, that is the claims, the sources of financing. And we have 2 basic sources of financing that we address first of all. So once we know that growth has occurred, we don't have to wonder how much liabilities and equity changed, at least in total, because the balance sheet has to balance. So our attention right off the bat when we go to look at the lower part is how that growth was split between the 2 basic sources of financing in the balance sheet, and that is debt and equity. Okay, so we want to find out whether most of that growth was financed with debt or equity, or if it was fairly evenly split. Secondly, we want to then identify the major changes that occurred within liabilities. That is, whether most of the growth took place in current, or most of the new debt financing was current or non-current liabilities. That once again speaks to the company's liquidity. And then also, going just one bit further, is to look now at equity. There are 2 basic forms of equity: paid-in capital and earned capital, which we know better as retained earnings. So you notice what we're doing in the debt and equity side is to look first of all to see whether the new financing was through debt or equity. And then we look specifically at debt and then look specifically at equity. So hopefully you see a flow of taking a very general view of things, getting a handle on very generally what happened, and then getting more specific with that. Well, we're going to take a quick look here at Goody's balance sheets. This is a fairly old set of balance sheets, as you can see by the dates here. I continue to use these even though I've had them for some time, for 2 reasons. First of all, I'm really lazy, but secondly, because this is a pretty interesting story and kind of an unusual one, as we'll see. Okay, the first thing we're going to do as we look at Goody's comparative balance sheets is to turn our attention to the assets, and that's what you see here. Notice there's Goody's balance sheet, at least the assets, current assets, long-term assets, PP&E, and so on, for 2002, 2003, and this represents the column showing the differences, the change from 2002 to 2003. Notice that number. These numbers are simply the following year, or the second year, minus the amounts on the balance sheet for the earlier year, and we see these changes here. Okay, the first step then in this approach is to start with assets and to look at growth. Did the assets of the company grow? In other words, did the company grow? If so, by how much in dollar terms and also percent terms? And we see here that the company's assets, these are, let's say, thousands of dollars, so this is $19.6 million. And sure enough, the assets during 2003, Goody's assets grew by $19.6 million. Now, in percent terms, we relate this change column to the earlier year. So 19.6 million divided by $396.2 million comes out to roughly about 5% growth. So we could say that during 2003, Goody's assets grew by $19.6 million, reflecting an increase of about 5%. Okay? So we've got both a handle on the dollar amount, the absolute amount of that growth, and also a relative amount. It makes a big difference as to whether a company is growing at 5% or 50%. And you may remember from class we had an exercise using Krispy Kreme balance sheets. And Krispy Kreme was actually growing in a number of years ago at rates of 40 and 50 and 60% annually in asset growth. So there's our first answer. So part 1A, one is looking at the assets. Part A says, what happened overall? What was the growth? They grew, during 2003, Goody's assets grew by $19.6 million, reflecting a rate of growth of 5%. The next thing we do is look at the breakdown between current and non-current assets. We don't have a total for non-current assets. We do for current. And of course, we can see from this that, in fact, all of the growth took place. All of this $19.6 million occurred in current assets, which grew by $39.2 million, while non-current assets must have fallen by about the same amount, about $20 million. And so there's part 1B. All of this increase, all of this growth took place in current assets, which increased by $39.2 million, while long-term assets actually fell by about $20 million. Okay? And part 3 then, that is part 1C, really, is to then go one step further and say, okay, of these line items here, which ones reflected the greater change? And if we look at that, we can see that cash, okay? When we're looking at these accounts, these line items now, which ones accounted for the greatest change? The answer is that the accounts that changed the most included cash, which grew by $46.2 million, followed by PP&E, which fell by $19.4 million, followed by net receivables, which fell by $7 million. And so that third step, that is actually step 1C, is to identify the line items here that represented the greatest change. So we see that that would be cash, an increase of $46.2 million, followed by PP&E, a decrease of $19.4 million, and then net receivables, a decrease of $7 million. So one thing we see from this, again, is that the company grew, $19.6 million. Most of that growth, actually all of that growth, took place in current assets, $39.2 million, while PP&E actually fell by $19.4 million. And then specifically, that increase or that change was mostly in cash, which grew by $46.2 million, while PP&E fell by $19.4 million and receivables fell by $7 million. So we've got an interesting picture here that happened to Goody's way back when. One of the reasons I keep using this is because there is an interesting story here. You don't find a company sitting on cash for very long, $46 million. So something interesting happened here that we'll address in just a moment. Let's go to the bottom part of the balance sheet, the debt and equity section. Again, we know already that debt and equity increased by $19.6 million because the balance sheet has to balance. And so we turn our attention right off the bat to that $19.6 million. Was most of that new financing? Was it debt? Was it equity? Was it an even mix of those? And what we see is that somewhat more than half of that increased new financing occurred here in liabilities, which grew by $11.2 million, while stockholders' equity grew by $8.4 million. So we might say here that most of the new financing, or somewhat more than half of the new financing, was in debt, $11.2 million, while stockholders' equity rose by $8.4 million. It's important to be able to identify those amounts Okay, to give enough information, not too much. Percent changes are not important here. For my purposes, I want you to try to keep it simple and keep it focused. And so this is what I'm trying to model for you here. Well, that's step 2A. Step 2B is to focus on debt. Was most of that new financing, that 11.2, was most of it current, most of it non-current? How was it split between those two? As you can see here, in fact, all of the new financing took place in current liabilities, which rose by $11.9 million, while long-term liabilities actually fell by about $0.7 million. And so we see again a picture of here where this additional debt was all current, okay, and in fact non-current liabilities fell. Okay, let's finish this picture out here then. What about that $8.4 million of shareholders' equity? Was that through stock issues? Was it through reinvested profits? Well, we can see here that most of that new financing was equity financing was in retained earnings, which rose by $7.6 million. For our purposes, we're going to treat everything else as if it had to do with with stock issues, with paid-in capital. This the way that these amounts are arranged here, capital surplus from Yahoo, actually represents the additional paid-in capital. So paid-in capital is going to be the sum of common stock and this capital surplus here. Retained earnings, of course, represents earned capital. Reinvested profits, its retained earnings is going to be the result of the beginning retained earnings balance plus net income minus dividends. Dividends, remember, represent a distribution of profits. And so this analysis, application of the two-finger exercise to Goody's balance sheets tells an interesting story. As you will recall, we saw that Goody's did grow $19.6 million. Its assets increased. All of that growth, in fact, in current assets, long-term assets, fell. And in fact, all of that growth in current assets was in cash. So what's going on? That's an unusual type of circumstance, and in fact, it was. What was happening was Goody's sold off a number of its stores in some of the areas where it faced stiffer competition, and so at least for the time being was sitting on a pretty large pile of cash, and as you can see, had a lower commitment in long-term assets than it had had before. Of course, the balance sheet has to balance, and so we see the increase reflected, that is the increase in assets reflected in increased funding here. The new funding was mostly in current liabilities, and in fact long-term liabilities fell, and in stockholders' equity, which increased mostly because of reinvested profits. Of course, this may reflect gains on some of those sales as well. The company did issue common stock, but the lion's share, at least, of the new equity financing was through retained earnings, reinvested profits. So that tells an interesting story to us. And here's just a quick summary of those basic techniques. First of all, we look at the assets. We identify the dollar and the percent change in assets that occurred during the period. Secondly, we will then identify any major shifts that occurred between current and non-current assets, or more basically, just to say, hey, where did that growth occur? Was it mostly in current assets or in non-current assets, or was it evenly split between those two? And then thirdly, identify the specific accounts, or at least the line items in the balance sheet that accounted for or represented that change. We're going from very general, broad picture to more specific. Secondly, that is the second part, is to look down below at the sources of financing. We first of all look at the split between debt and equity. If the company grew, it had to obtain new financing. Was most of that through fixed cost debt financing, or was it through equity? And then we look specifically at debt. If there was an increase in debt, was most of it current or non-current, short-term or long-term? And then finally, for equity, if there was a change in equity, was most of it in paid-in capital? That is, did the company issue or repurchase stock, or was it in retained earnings? Did the company reinvest profits during the period, or perhaps did it actually lose money during the period? So it's a very simple, but I think very helpful approach to getting just a handle on any given company, what happened during the period. And as I've said before, with regard to other techniques, if you can do it for one company, you can do it for 100 companies. Don't forget to visit our concession stand for a great selection of snacks and beverages.